Good evening, everyone. We're a little bit late by a few minutes, but that's okay. I've been having some technical difficulties on this end. So we're on episode 13, y'all. I can't believe it. We are now at the halfway point of this series. I can't believe how quickly it's gone from doing just one episode a night to suddenly graduating the course that I went to and now doing it 3 nights a week. It really sped up quick. So tonight we are discussing reporting. We're going through the profit and loss and the balance sheet, what the differences are, what's on there, and we've gone over this a couple of times, but we're going to really dive in deep to this tonight. And if we've got enough time, I'm going to go on ahead and add 1 to 2 more reports, specifically one that you'll also be using, or at least you should. So as a reminder, I need all of you to enable StreamYard. Go to the 3 little buttons on the bottom right corner of the video, and click enable. This allows me to see who's posting a comment. Otherwise, it comes up as anonymous and it doesn't help me at all. So I always do, I just let everybody know why I do this. Just as a reminder, I like to put it out there. I'm out there to help all of you. So small business owners, especially this year, have a difficult time, quite possibly, with their finances, especially with hiring a bookkeeper. Whether it's on a contract basis or an employee basis. And you should not be failing at your financials. You need to know what the financial health of your business is. To know what the financial health of your business is means that you know exactly how much money you're making every single day, every single week, every single month, and by the end of the year. You know how much profit you've made. You know how much you've spent on expenses. It's never, ever, ever a good thing for you to look at your checkbook and say, I have money in my account, therefore I'm okay. That is not a good thing. And I'm telling you right now, it's going to stop today if you're doing that. I want you to pay attention to what it is that we're doing here so that you can successfully manage your financials, manage your books, so that you don't have to do that anymore. Because I guarantee you, doing it the way that you may be doing it right now, you're going to be in trouble. Because what happens when you start writing a batch of checks? You've just paid all of your bills. Let's just say you've spent $20,000 in your money towards vendors for whatever, utilities, rent, mortgage, loans, whatever it is that you're spending your money on. And then you forget. You look at your checking account and suddenly you say, oh, well, I've got $21,000 in the bank. I'm good. But you just forgot that you spent $20,000 in bills. And you go and you spend $15,000 on a piece of equipment. Next thing you know is you are in some deep doo-doo. So let's not do that, please. Okay, so always I do a review of the previous night's lesson. And I am just going to take this from last night. There's not going to be any slides for tonight's lesson, so you'll have to pay attention. So let me share my screen. Come on, come on, come on. Okay, as you remember, we are on the wrong review here. Okay, so as you remember, we talked about income and owner's equity and what those differences are. So quickly, we're going to go through this. Income is money received, especially on a regular basis for work or through investments. Every company needs to earn a profit to be successful, but what is profit? Profit is the remaining revenue, also known as income, after a company has accounted for all expenses. Why is profit important? It is an essential outcome of running a business, because without an income stream, employees don't get paid, bills don't get paid, and you, the business owner, do not get paid. There are three types of profit. There's gross profit, which is the company's revenue minus the cost of goods sold. Operating profit, which is the accounts for cost of goods sold and the cost of operating expenses. And then there's net profit, which is the remaining revenue after accounting for every business expense, including taxes and interest. The ways to increase profit would be to increase your revenue, which means to raise your prices, sell more products, and or find new customers. You can cut costs. Those are direct costs, which are related specifically to the development of the product or service, or indirect costs, which is overhead. Those are the indirect expenses related to running your business. Those would be your utilities, your mortgage, your rent, your office supplies, things like that. You can remove products or you can reduce inventory. Those are all options. And I showed you a little bit of that. What is owner's equity? It is the proportion of the total value of a company's assets that can be claimed by its owners. The amount of ownership you have in your business after subtracting your liabilities from your assets. Owner's equity is important because it helps you evaluate your finances. Now, remember, I put the general owner's equity equation in here. So pay attention. What is owner's equity? Money invested by the owner of the business plus profits of the business since its inception, minus money taken out of business by the owner, minus money owed to others. And if we go back, you see here, this is the equation. Owner's equity equals assets minus liabilities, or assets minus liabilities equals owner's equity. Can owner's equity be negative? Yes, if the business's liabilities are greater than its assets. The owner may need to invest additional money to cover the shortfall if this is the case. When a company has negative owner's equity and the owner takes draws from the company, those draws may be taxable as capital gains on the owner's tax return. What are owner's draws? An owner takes a draw for personal expenses and owner's pay. This should not be confused with payroll. And again, why? What are the different equity accounts? Owner's equity, also known as owner's investment in QuickBooks Online. This is the money the owner has invested in the company, and it's also how to account for purchases you made for the company from any personal accounts. We don't count any of these as loans. The owner's draw, also known as owner's pay and personal expenses. If the owner has made personal purchases with business money, and again, I highly, highly, highly recommend you steer clear from doing this, this would be counted as an owner's draw and is determined as income on your personal taxes. If the owner is taking pay for their work that is not on payroll. Again, if you're a sole proprietor, you are not supposed to be taking a payroll. You cannot be an employee. This would be for, excuse me, this would be more for a corporation, possibly an LLC that is more than just a single member. This would be considered as owner's draw / owner's pay. This would also be determined as income on your taxes. So you end up taking a large hit on your personal taxes whenever you do this. This is necessary. This is not. So when I say I highly recommend that you steer clear away from this, it's because you're commingling funds and you should never do that. That is wrong. If you have an LLC, if you had an attorney file your LLC paperwork for you, your attorney should have told you absolutely not. Absolutely no commingling of funds. Okay. So let's get into the meat and potatoes. This is where we're going to show you the reports on QuickBooks. So let me share my screen again. Okay, so when we're looking at reports, and I'm in the sample company, we have a whole laundry list of reports, and it all depends on which version you have. So for me, I have the accountant's version, so obviously I'm going to have every report under the sun. But if you have the self-employed version, I'm not sure you'll have any of these, because self-employed works best on your phone or on your tablet. If you are working with the essentials, you're only going to have 3 reports. So the higher you go in the type of subscription that you get, the better you're reporting, the more you're reporting. And I can tell you this, and I think I've told you this once before when we went over the chart of accounts, your subscription will also dictate how many categories or accounts you can have in the chart of accounts. So in other words, if you are a business who knows that you're going to have to add 75 accounts or 75 categories to your chart of accounts in order to be customized to your business, because QuickBooks will create a set of chart of accounts just for you, but they're all generic and they are the same accounts that everybody gets. It's not like QuickBooks Desktop where you tell it what industry you're in and it will formulate the accounts just for your industry. This is all generic, every bit of it, and everybody gets the same ones. So if you have the 2 bottom tiers of your subscriptions, you're only going to get up to 5 categories. My goodness, excuse me. You're only going to get up to 5 categories, customizable categories. If you have the 3rd tier, which is the one I recommend to everyone because of this, you get 250. So yeah, it jumps from 5 to 250. So you're almost guaranteed that you're not going to go over that. Almost guaranteed. Now, if you are a corporation and you have 5 different locations and you've got all of these warehouses and inventory and all this other stuff, then you're going to need the mother load of all subscriptions so that you get an unlimited amount of categories. So, okay, so the profit and loss. I showed you this last night. So remember, your profit and loss is your income and expenses Profit and loss is also known as an income statement. It accounts for all of your income, your cost of goods sold. Then you come up with your gross profit. So what happens is you bring in all of your income. Your cost of goods sold is actually subtracted from your income, leaving you with what's left in income only. Then we've got all of our expenses. These could be materials expenses just for your plant. If you have a construction company or a company that deals specifically in product that you sell, then those material expenses would not necessarily be used for any other purpose other than your own location, just for company use, not for selling to your clients or your customer base. That would be a cost of goods sold. So here we've got things like professional fees, which is going to be accounting, lawyers, tax professionals. They actually put bookkeeper in here, but believe it or not, and you can ask any bookkeeper this, absolutely any. It's not fair, because as a bookkeeper, we are professionals, and CPAs couldn't do anything without bookkeepers, because many CPAs don't do bookkeeping. So they put it here in bookkeeping, or sorry, in legal and professional fees, but unless they've changed things without me knowing it, they do not consider a bookkeeper to be a professional fee or a professional expense. They want us to make ourselves different from the rest, and actually put bookkeeping fees by itself. So so I kind of like the fact that they're actually putting it in here with the legal and professional fees, but unless they've changed things recently, we're not allowed to do that. So your meals and entertainment, all of your office expenses, whether this is office supplies, could be paper for your printer if you're doing a lot of printing. It could be furniture. You know, let's say that you went to the marketplace on Facebook and you found a desk for $100. That's where this would go. Your rent or lease, this could be rent of your office space. It could be post office box rent. Obviously your utilities. And then we've got other expenses. So they put something in here for miscellaneous. I hate that category. You should never be putting anything in miscellaneous, ever. But if I click on this, yeah, these are definitely not miscellaneous expenses. So this would be insurance. These two could quite possibly be cost of goods sold. So like I said, this is a sample company. They've done things the way that they want to help you learn. So that's what all of this is. There's also something called other income. Other income could be interest expense that you are accruing on a credit card, or maybe a savings account. So that is what your P&L is, your profit and loss, also known as the income statement again. And this is probably the #1 report that you will be using, because this is what you need to determine how much money you made. You see net income. It's saying that after all of the expenses subtracted from the profit, this is how much you profited. That's how much income you have for the year. If you have expenses that are greater than your income, this will be a negative. It would be a net loss. It would still say net income, but it would be a net loss. And I can tell you that banks and loan companies and such, they frown against that. So we all have a bad year. It's inevitable, especially when you're starting out. But if you have been doing what you're doing for 20 years and you're highly successful at it, this should not be a negative. Okay. Next, we've got the balance sheet. The balance sheet is where you find your owner's equity. These are your assets. Remember what I said about the equation. Your assets minus your liabilities equals your owner's equity. So all of your assets are your bank accounts, your accounts receivable. So any money that is on the books to be coming to you, but you haven't collected yet, that is your accounts receivable. Inventory is an asset. Your undeposited funds. What is an undeposited fund? That is basically if you work on accrual. So let's say you received a check in the mail. You put it into QuickBooks saying that you received this check. You actually receive the check in QuickBooks and let it know, yep, I got the money. But you don't deposit it for 5 days. For whatever reason, you forgot, you got busy, you haven't, with everything going on, you haven't gotten out of the house to go to the bank, or your phone doesn't work or something for the app, whatever. It's going to go into undeposited funds, meaning that it has not been deposited yet. And you can change this. You can change it so that it goes directly into the bank. I don't recommend that, because if you do that, but then you don't deposit the check for a few days, there's going to be a problem, a potential problem. So we put that into undeposited funds. In 5 days, it shows up in the bank. Then you do a deposit in QuickBooks and say, okay, yes, I've received the money. You tell it what date it was deposited. You find the invoice that you have received the money from. You click on that and you say deposit. So it takes it out of undeposited funds and puts it in the bank. So that's actually a really good way of looking at it. When you put it in undeposited funds, it doesn't hit the bank. It sits in undeposited funds until you deposit the money. But you have to make the switch physically. It won't do it for you. Anyway, we've got our fixed assets. These would be your trucks, like this shows. This would be a building. It could be land, equipment. The IRS determines that things like computers, software, office furniture is not deemed as a capital asset unless you have spent a certain amount of money on that. So the last time I checked on computer equipment and software, it's $5,000 the last time I checked, which is a little extreme considering that the average person does not pay $5,000 for a computer. So it's up to you. When you put it in fixed assets, not land, when you put anything else in fixed assets, you're going to be depreciating it. That's what this is, the original cost. That's how much you originally paid for the truck. And then once you start depreciating it, it actually shows you how much depreciation you've taken on it. And then here on truck, it actually shows you the new cost of that truck, or the updated cost. Land does not get depreciated. If you remember from a few days ago, it does not get depreciated because it doesn't have the normal wear and tear as everything else does. It doesn't depreciate. Okay, your liabilities is going to be your accounts payable, money owed by you to vendors, your credit cards, other current liabilities, which would be like this, your revenue payable, loans, but these are not your regular loans. These could be, I hate using this example, this could be a payday loan. I'm sure everybody is familiar with what a payday loan is, those horrible, horrible 1-month loans that charges you 200 to 250% interest. That's a loan payable under the current liabilities. Then we've got long-term liabilities. You see notes payable and loan payable. A notes payable is something you hold a note on. It could be a mortgage. It could be a car payment. Those are specifically loans that you're going to hold for 2 to 10 years or more. Okay, your equity. Now you notice that we don't have owner's equity in here. We had actually placed something in here last night, but again, as we discovered with the sample company, it actually resets itself every single night. So we've got the opening balance equity. There should never be anything in here unless you've opened a new account, purchased a new loan, or sorry, purchased a new piece of equipment or a vehicle or something. You have to have that opening balance equity for something that is brand new like that. Everything else should always have another account that it's going to be going to. And this is your net income. Remember, we looked at this from the profit and loss. That's what this is. Now, in the balance sheet, if you're looking on QuickBooks Desktop, when you go to the balance sheet, it always brings up an accumulative balance sheet. So in other words, it's always going to be all information preceding that date, always. In QuickBooks Online, you actually have to choose. So if you are doing a set of reports just for the previous month, so that you know what you did the previous month, it's going to show here just that month. If you do it for the entire year, it's going to show you the entire year. That's not the case in QuickBooks Desktop. In Desktop, what ends up happening is you do your monthly reports and you've got your net income from the month. But when you look at the balance sheet, this is going to be for the year. That's the way that software works. So you've gotten your total liabilities and equity. Now, a sole proprietor, even a single member LLC, doesn't necessarily go with a balance sheet. Your CPA, a tax professional, does not look at a balance sheet if you are a sole proprietor or single member LLC. This doesn't come into play typically until you are a partnership or a corporation. And we've got just a couple of minutes left if we really want to look at something else. So one of the other things I want you to see quickly is, let's see here, this one right here, your statement of cash flows. This is another report that I would like for all of you to be looking at and studying every single month. This tells you where all of your money goes. It gives you your beginning balance of, well, this one's a little bit different. What it should be telling you is that you've got your beginning balance, your bank balance. And every single week, it shows you the fluctuations. So it tells you this week, this much money came in. This week, this much money may have gone out. But it's always a combination of two things. It's always in and out. So it gives you your beginning balance for the bank and the ending bank balance. So it gives you a really good sense of where your money is going. And I always give this to my clients, especially those that have a really difficult time with cash flow. So I want you to look at all of this, excuse me, and kind of put into a notebook or on a sticky note or somewhere that you can see where you're going to remember. I want you to be able to look at that and say, okay, these are the reports that I need every single month. And then maybe per quarter, per year, definitely per year. The P&L statement, the P&L report, that's going to be going to your CPA. It's going to be going to your tax professional in order to file your taxes. It's always best to have your receipts with you as well. So again, the balance sheet, not necessarily needed unless you are a partnership or a corporation. And your cash flows report, always a good idea to have for your own information, not for anyone else, just yourself, so that you see where your money is going. So I think that is it for this evening. We are not having any episodes, any videos going on next week or the week after. Is that correct? Yeah. Whew. Next Friday is Christmas already. Can't believe it. So many, I know that things are so different this year, but I do know that there's a lot of states that are not on complete restrictions like other states are. And so some people are still going to be traveling. So I don't want you to have to think about watching videos or, oh, I just missed a video, whatever. So we're not going to have any videos for the next 2 weeks. It's probably going to be too busy for everyone. So we will reconvene in the new year on January 5th, 2021. Let's pray that is a much better year. And actually, we've already gone over the statement of cash flows, and that's what our next lesson is on. So we'll start looking for something else that we can talk about for that one specifically. But I bid all of you a good evening and a Merry Christmas, a very happy, glorious, stress-free Christmas. And I wish all of you a very prosperous new year. I know that word prosperous hasn't meant a whole lot for us this year. So let's really put emphasis on that word for next year, shall we? Next year is going to be prosperous for us all. So I hope you all have a very nice evening and a wonderful weekend. And I will see you in 2 weeks. Good night.